Nikko Asset Management's latest ETF, which will be listed in August, provides diversified exposure to investment-grade corporate bonds. The index that the ETF tracks has a yield to maturity of about 3% as of 30th June, which is higher than government bonds and bank deposits. There is no currency risk for the local investor as it is Singapore dollar denominated. Being exchange traded, the ETF provides continuous price transparency and is accessible to both large and small investors alike. The ETF can be used as a diversification tool by all investors in building a balanced portfolio, given its low correlation versus equities. The past 5-year correlation is 0.3. Also, the ETF has something to offer for both the conservative investor and the slightly more ambitious. The underlying index has a yield of about 3%, and it provides safety given that about half of the underlying bonds are issued by quasi-government statutory boards and major Singapore banks. The ETF sits somewhere in the middle of Singapore's fixed income risk spectrum. Government bonds are guaranteed by the government and has the lowest credit risk, but the yields there are quite low. High-yield bonds carry a lot more credit risk. Diversification is a key benefit of the investment-grade corporate bond ETF. It diversifies sectorial and issuer-specific risks. If we look at the history of corporate bond defaults from 2015, they comprise mainly of non-rated high-yield issuers, unlike the ETF which invests in investment grade. Also notice that the defaults are concentrated in the energy and maritime sectors. Recall that oil prices collapsed from $100 to almost $20 a few years ago. The overcapacity in the shipping industry has also been widely reported. To conclude, with the Nikko AM SGD investment grade corporate bond ETF, investors gain access to a high quality asset class that has not always been easy to access.